You're watching silver prices hit record highs right now. And you might be wondering if you've already missed the opportunity. But what if I told you that what's happening in the silver market right now is completely different from any price rally we've seen before? What's unfolding isn't just another speculative bubble. It's a fundamental restructuring of how silver is priced, traded, and valued globally. And if you don't understand what's really driving this, you could make decisions that cost you thousands of dollars. I'm going to break down exactly what's happening in the silver market, why industrial demand is creating unprecedented pressure, and what this means for your investment strategy. But before we dive in, if you find value in getting real, no-nonsense financial analysis, hit that subscribe button and turn on notifications so you don't miss our next breakdown. Now, let's talk about what's really happening with silver. Silver recently climbed near $99 per ounce, reaching new record highs, and this isn't just a temporary spike. Prices have risen more than $64 compared with 1 year ago. That's more than a 200% increase in 12 months. To put this in perspective, silver traditionally trades between $15 and $30 per ounce. We're now in completely uncharted territory, and this dramatic movement has caught the attention of investors, industrial buyers, and financial institutions worldwide. But here's what makes this rally fundamentally different from previous silver rallies. In 1980, the Hunt brothers attempted to corner the silver market through speculative buying. In 2011, silver spiked to $50 during concerns about inflation and currency devaluation. Both of those rallies were driven primarily by speculation and fear. What's happening in 2026 is fundamentally different. This rally is being driven by something that can't be solved by simply waiting for speculators to lose interest. It's being driven by actual, physical scarcity created by industrial consumption that's permanently removing silver from available supply. Let's talk about the supply and demand situation because this is where things get really interesting. The global silver market has been in a persistent structural deficit since 2021. What does that mean in practical terms? It means that every single year since 2021, the world has consumed more silver than was produced through mining and recycling combined. In 2025, global mine supply was estimated at 813 million ounces, while total demand crossed 1.24 billion ounces. That's a deficit of over 400 million ounces in a single year. Think about that. The world needed almost 1.25 billion ounces of silver, but only produced about 813 million ounces. Where did the remaining 400+ million ounces come from? It came from existing inventories, from stockpiles, from exchange vaults, from anywhere physical silver could be sourced. And here's the critical part. This ongoing deficit has started to impact physical availability, particularly as metal flows from Western markets to other countries. The silver that's being pulled from these inventories isn't coming back. It's being consumed in applications where recovery is either impossible or economically unfeasible. Now you might be thinking, okay, there's a supply deficit, but can't mining companies just produce more silver to meet demand? This is where the silver market has a unique problem that makes it different from almost every other commodity. Most silver comes as a byproduct of other metal operations rather than dedicated silver mines. So without major expansion in copper, lead and zinc production, new silver supply remains limited. Let me explain why this matters. When the price of gold goes up, gold mining companies can increase production specifically to take advantage of higher prices. But silver doesn't work that way. Roughly 70% of silver production comes as a byproduct when companies mine for copper, lead, zinc, and other base metals. So even though silver prices have tripled, mining companies can't simply decide to produce more silver. They would have to massively increase copper or zinc mining, which depends on entirely different market dynamics and demand. This creates what analysts call supply inelasticity. The supply cannot quickly respond to price increases. The capital-intensive nature of mine development means supply responses require 5 to 7 years of development time. That means even if companies started major new mining projects today, the additional silver wouldn't reach the market until 2031 or 2032. Now let's talk about what's driving demand, because this is where silver's role in the global economy has completely transformed. Industrial applications now account for more than half of total silver consumption. Silver isn't just a precious metal anymore. It's become a critical industrial material that's absolutely essential for modern technology. Let's break down the major industrial uses. Solar panel manufacturing has become one of silver's largest end uses, and the renewable energy build-out shows no signs of slowing. Every solar panel requires silver because it has the highest electrical and thermal conductivity of any metal. There's no substitute that provides the same efficiency. As countries around the world push toward renewable energy targets, solar panel production is accelerating dramatically. Electric vehicles also require significantly more silver than traditional cars, and as EV adoption accelerates globally, automotive demand for the metal continues to grow. A traditional gasoline-powered car might use half an ounce of silver in various electrical components. An electric vehicle can use anywhere from 1 to 2 ounces, sometimes more, in battery management systems, power electronics, charging infrastructure, and sensors. And it's not just solar and EVs. Emerging applications in data centers and artificial intelligence infrastructure are creating new demand sources that didn't exist 5 years ago. High-performance computer chips, thermal management systems, and electrical connections in AI servers all require silver. As companies invest billions in AI infrastructure, they're consuming silver at unprecedented rates. The medical industry uses silver for its antimicrobial properties in instruments, wound dressings, and coatings. The electronics industry uses it in smartphones, tablets, computers, and virtually every electronic device because of its superior conductivity. Photography, though declining, still uses silver. Jewelry and silverware create consistent demand. And increasingly, investors are buying physical silver as a store of value and inflation hedge. Here's where the supply situation gets even more complicated. Starting January 1, 2026, China is implementing new export restrictions on refined silver. This isn't a minor policy change. This is a strategic move that's fundamentally disrupting global silver supply chains. China currently controls between 60% and 70% of the world's refined silver supply. Let that sink in. China refines more than half of all the silver used globally. Under the new export rules, only large, state-approved companies can export silver, and they need special government licenses. To qualify, firms must meet 2 stringent conditions: an annual production capacity of at least 80 tons of silver and credit lines of $30 million. What does this mean in practice? It means hundreds of smaller and mid-sized refiners who previously supplied Western manufacturers are now blocked from exporting. Their silver stays in China. It goes to Chinese electric vehicle manufacturers, Chinese solar panel producers, Chinese electronics companies. Western companies that previously relied on this supply are scrambling to find alternative sources, and there simply aren't enough alternative sources available. This is resource nationalism at work. China is using its dominant position in silver refining to give Chinese industries preferential access to a critical strategic material. And unlike temporary export restrictions that might be negotiated away, these controls appear to be structural and permanent. This move mirrors China's earlier strategy with rare earth metals, where export controls were used to secure domestic industrial advantage and global pricing power. Now let's talk about how silver is actually traded and priced, because understanding this helps explain why prices are moving the way they are. Silver trades on commodity exchanges, primarily COMEX in New York and LBMA in London. On these exchanges, most trading involves futures contracts, which are essentially promises to deliver silver at a future date. Here's where it gets interesting. The paper silver market, meaning futures contracts, ETFs, and various derivative products, is much larger than the physical silver market. For years, the price of physical silver was determined by the paper market. If COMEX futures were trading at $25, that's what physical silver cost, plus small premiums for fabrication and delivery. But something has changed recently. Since January 1st, Beijing has restricted the export of physical silver to the world market, putting additional pressure on inventories in important storage locations such as London and Zurich. The measures have also temporarily driven up leasing rates for silver to over 8%. In normal markets, lease rates for silver run between 0.5% and 2%. When lease rates spike above 8%, it signals that physical metal is genuinely scarce and difficult to obtain in the short term. What we're seeing now is the beginning of a disconnect between paper prices and physical prices. In markets where physical silver is readily available, prices track close to the futures market price. But in markets facing physical shortages or delivery delays, premiums over the spot price are expanding dramatically. This suggests the paper market is losing its ability to accurately reflect the true clearing price for physical metal. So what does all of this mean for investors? First, let's be absolutely clear about something. I'm not here to tell you whether you should buy silver or not. That decision depends on your individual financial situation, risk tolerance, investment timeline, and overall portfolio strategy. What I can do is help you understand the factors that are driving the market so you can make informed decisions. If you're considering silver as an investment, you need to understand the different ways to gain exposure. You can access silver through physical ownership or silver-backed exchange-traded funds. Physical ownership means buying actual silver coins, bars, or rounds. The advantage is you own the metal directly. The disadvantages are storage, insurance, security concerns, and potentially large bid-ask spreads when you buy or sell. Silver ETFs allow you to gain exposure to silver prices without dealing with physical storage. The fund holds physical silver, and you own shares that represent a claim on that silver. The advantage is liquidity and convenience. The disadvantage is you don't directly control the metal, and there can be questions about whether ETFs would be able to deliver physical metal if a large number of shareholders simultaneously wanted to redeem shares for physical delivery. There are also silver mining stocks which give you exposure to companies that produce silver. These can amplify gains when silver prices rise, but they also come with company-specific risks like operational problems, management decisions, and costs unrelated to silver prices. Now let's talk about realistic expectations because this is crucial. Yes, silver has more than tripled in the past year. Yes, there's a structural supply deficit. Yes, industrial demand is growing. But that doesn't mean silver will continue rising in a straight line, and it certainly doesn't mean silver is a guaranteed investment. Historically, silver trails other investment options, like stocks. From 1921 onward, silver has underperformed the S&P 500 by about 96%. Over long time periods, equities have dramatically outperformed silver. Silver's value proposition isn't necessarily about generating maximum returns. It's about diversification, inflation hedging, and preserving purchasing power during economic uncertainty. Silver is extremely volatile. The question isn't just whether silver prices can rise, they clearly can. It's whether they can rise faster than gold and then stay there. Silver has a history of explosive rallies followed by sharp corrections. In 2011, silver reached $50 and then crashed back to below $30 within months. Anyone who bought at the top and sold at the bottom lost 40% or more. Tata Mutual Fund cautions that sharp corrections cannot be ruled out in 2026 as prices remain elevated and vulnerable to profit-taking, portfolio rebalancing, and shifts in global growth expectations. When an asset has tripled in value in 12 months, it's reasonable to expect volatility and potential pullbacks as some investors take profits. Let's zoom out and look at the bigger picture of what's happening here. Silver is transitioning from being primarily a monetary metal and investment vehicle to being a critical strategic industrial material. The 2026 rally is driven by the physical necessity of the metal in the modern power grid, not just by speculation or inflation fears. This transition has profound implications. When silver was primarily an investment asset, its price was driven by sentiment, fear, inflation expectations, and competition with other safe haven assets like gold. Now, with industrial demand consuming more than half of annual supply, silver's price is increasingly driven by fundamental supply and demand dynamics in technology sectors. The International Energy Agency estimates that by 2030, solar and EV sectors alone could consume roughly half of global silver output. If that happens, it means jewelry, coins, bars, and investment demand would be competing for a shrinking pool of available supply. This could structurally support higher prices over time. But there are also potential demand destruction scenarios to consider. At $99 per ounce, silver becomes expensive enough that industries have strong incentive to find substitutes or reduce silver content in products. Solar panel manufacturers are already working on technologies to reduce silver usage per panel. Electronics manufacturers are exploring copper and aluminum alternatives where possible, even though they result in some efficiency loss. If you're interested in the silver market, here are the key indicators to watch. First, watch monthly inventory levels at major exchanges like COMEX and LBMA. Inventories in key hubs such as London, China, and the US have fallen to multi-year lows. If inventories continue declining, it supports the scarcity narrative. If inventories stabilize or increase, it suggests supply is catching up to demand. Second, watch industrial production data for solar panels, electric vehicles, and electronics. If production growth accelerates, silver demand should increase. If production slows due to economic concerns or high silver prices forcing substitution, demand could moderate. Third, watch mine production reports. While production can't increase quickly, any major new mine discoveries or production increases would add to supply and potentially ease the deficit. Fourth, watch developments in China's export policies. Any loosening of restrictions would increase available supply to Western markets. Any tightening would further constrain supply. Fifth, watch the gold-to-silver ratio. Historically, this ratio has ranged between 50:1 and 80:1, meaning it takes 50 to 80 ounces of silver to equal the value of 1 ounce of gold. The ratio has compressed recently as silver has outperformed gold. If it continues compressing toward 40:1 or 30:1, it suggests silver is becoming relatively more valuable. If it expands back toward historical averages, it suggests silver may be overvalued relative to gold. Here's what I want you to take away from this analysis. The silver market is experiencing a genuine structural supply deficit driven by industrial demand for technologies that are critical to global energy transition and technological advancement. This isn't speculation. This is documented in supply and demand data from multiple industry sources. At the same time, silver remains a volatile asset with significant price risk. Past performance, even recent spectacular performance, does not guarantee future results. The same supply deficit that's driving prices higher today could resolve in unexpected ways. Technological substitution, recycling improvements, new mine discoveries, or changes in global industrial policy could all impact the supply-demand balance. If you're considering adding silver to your portfolio, financial advisors typically recommend limiting precious metals exposure to 10 to 15% of your total portfolio, with an overall cap of 20% for all precious metals combined. Diversification remains the cornerstone of sound investment strategy. Before we wrap up, I want to hear from you in the comments. Are you currently invested in silver? Are you considering adding silver exposure? What's your strategy for navigating this volatile market? Share your thoughts below. And if you found this analysis valuable, please hit the like button and share this video with anyone who's trying to understand what's really happening in precious metals markets right now. Remember, the goal isn't to chase returns or get caught up in hype. The goal is to make informed decisions based on solid understanding of market fundamentals. Whether silver continues rising, consolidates at current levels, or experiences a correction, understanding the underlying supply and demand dynamics puts you in a better position to make decisions that align with your financial goals. Subscribe to Money Aftermath for more no-nonsense financial analysis that cuts through the hype and gives you the information you need to navigate complex markets. I'll see you in the next video.